Two people walk into the same bank on the same Tuesday afternoon. They're the same age, same job title, same credit score, same income. The only difference is one of them has $98,000 in combined assets, and the other has $102,000. $4,000 apart, less than the price of a decent used car. The person with $102,000 gets offered a meeting with a private banking specialist, a preferred interest rate on a personal line of credit, and a waived annual fee on a premium rewards card. The person with $98,000 gets a brochure and a thank you for stopping by. Same bank, same Tuesday. $4,000 of net worth separating two completely different experiences of the same institution. And the bank is just the beginning. Because what happens at $100,000 in net worth is not just about how a bank treats you. It's about how landlords evaluate your application, how employers perceive your negotiating position, how lenders price your debt, how the entire financial system, which is built around assessing risk, quietly recategorizes you the moment you cross certain invisible thresholds. Today, I'm going to walk you through the specific milestones where this recategorization happens, what unlocks at each one, and why the compounding effect of those unlocks is worth far more than the milestone number itself. My name is Josh, and I've spent more time than I should have mapping the exact points where money starts making money in ways that have nothing to do with investing. Subscribe if that sounds useful, and stick around because the last threshold I cover is the one that surprises people most.
Let's start at the beginning, because the first threshold is lower than most people expect, and its impact is more immediate than any of the ones that follow. The first threshold is $10,000 in liquid savings. Not invested, not in a retirement account. Liquid, accessible, sitting somewhere you can reach it without a penalty or a market timing concern. At $10,000 in liquid savings, three things happen almost immediately that have nothing to do with the money itself. First, your credit utilization behavior changes. People with meaningful liquid savings are documented to carry significantly lower credit card balances relative to their limits, which directly improves their credit utilization ratio, which is the single largest variable in a credit score calculation. A better credit score means cheaper debt. And cheaper debt means lower interest payments on every future mortgage, car loan, and personal line of credit for the rest of your financial life. The compounding effect of a better credit score over 30 years of borrowing is worth tens of thousands of dollars in saved interest, all of it traceable back to having $10,000 sitting in an accessible account.
Second, your job negotiating position changes. Research consistently shows that people without liquid savings accept job offers faster, negotiate less aggressively, and accept lower starting salaries than their qualifications warrant because the cost of a prolonged negotiation is too high when every week without income is a genuine emergency. $10,000 in liquid savings is enough runway to negotiate. It's enough to walk away from a bad offer and wait for a better one. The salary difference that results from one better negotiated offer, compounded over a 30-year career, can exceed $500,000 in lifetime earnings. Third, your rental application becomes dramatically more competitive. Landlords in competitive markets routinely run financial background checks that include asset verification. An applicant with $10,000 in savings is a categorically different risk profile than an applicant with $400, regardless of whether both applicants have identical incomes and credit scores. In a market where 5 qualified applicants are competing for one desirable unit, the one with visible liquid savings wins the application more often than not. That apartment, in a better building in a better neighborhood, affects your commute, your stress levels, your social environment, and frequently your career trajectory in ways that compound quietly over years. The second threshold is $50,000 in net worth, and this is where the financial system begins to treat you as a genuinely different category of person, rather than simply a better version of the same category. At $50,000 in net worth, you cross what most banks define as the lower boundary of their mass affluent tier. This is not a marketing term. It is a risk classification that triggers specific and tangible changes in how financial products are priced and offered to you. At this threshold, you become eligible for relationship banking at most major institutions, which means a dedicated point of contact rather than a general customer service line.
preferential pricing on products like home equity lines of credit, and access to financial planning resources that are simply not offered to customers below this tier. More importantly, $50,000 in net worth produces a documented shift in your insurance pricing. Home and auto insurers use credit-based insurance scores that are heavily correlated with net worth, and the pricing difference between a low-score and high-score customer on an identical policy can exceed 40%. That difference, paid monthly for decades, is a significant and entirely avoidable cost that disappears the moment you cross into the territory where your financial profile is no longer classified as elevated risk.
The third threshold is $100,000 in combined liquid and invested assets. And this is the one that Charlie Munger famously called the hardest money you will ever make. Not because $100,000 is a large number in absolute terms, but because of what it signals about you to every institution that is paying attention. At $100,000, most major banks trigger their premium or preferred tier, which comes with a specific and concrete set of advantages. Monthly maintenance fees disappear entirely. Out-of-network ATM fees are refunded automatically. Rewards rates on credit cards are enhanced. Savings rates on deposit accounts are bumped to competitive levels. And perhaps most importantly, your access to credit expands significantly. Lenders who declined you or offered you unfavorable terms at lower asset levels will offer you competitive terms at this threshold, because $100,000 in assets represents a level of financial resilience that statistically predicts responsible debt management. The mortgage rate you qualify for at $100,000 in assets versus $20,000 in assets can differ by half a percentage point or more. On a $350,000 mortgage over 30 years, half a percentage point is approximately $36,000 in additional interest. That $36,000 is not the result of any investment decision. It is the result of a threshold dividend, the compound financial benefit of simply being on the right side of an institutional boundary line.
The fourth threshold is $250,000 in investable assets, and this is the one that most people outside the financial industry have never heard of because it operates almost entirely invisibly. At $250,000 in investable assets, you cross the lower boundary of what the SEC defines as an accredited investor in terms of asset-based qualification. This classification, which most people assume is only relevant for exotic investments they'd never want anyway, actually unlocks a broader and more important change in how financial advisors interact with you. Below this threshold, most fee-based financial advisors will not take you on as a client, or will place you in standardized managed portfolios with limited customization. Above it, you gain access to genuinely personalized financial planning, tax optimization strategies that require a certain asset level to implement effectively, and advisor relationships where the advisor's compensation is aligned with your outcomes rather than with product sales. The quality of financial guidance available at $250,000 versus $50,000 is not marginally better. It is categorically different. And the long-term impact of that guidance quality on investment outcomes, tax efficiency, and estate planning is documented to be substantial.
The fifth threshold is $500,000 in net worth, and this is the one that surprises people most because its most significant unlock has nothing to do with banks, lenders, or financial advisors. At $500,000 in net worth, using the standard 4% safe withdrawal rate, your invested assets can generate approximately $20,000 a year in passive income. That number, $20,000 a year, is below a livable income in most markets, but it is above zero. And above zero changes everything about your relationship with work in ways that are psychological as much as financial. When your portfolio is generating $20,000 a year without you doing anything, you are no longer entirely dependent on your employer for your survival. You have what researchers in the financial independence community call partial financial independence. And partial FI produces the same negotiating dynamic that $10,000 in liquid savings produces at the job offer level, but at a much larger scale. You stop accepting unreasonable demands because you can absorb a period of unemployment. You negotiate raises more confidently because the cost of losing the job has become survivable. You take on more challenging and visible projects because you're operating from a foundation of security rather than fear.
None of these behavioral changes require you to actually use the $20,000 a year. The behavioral change comes from knowing it's there. And the career outcomes that follow from operating with that level of psychological security compound over years into an earnings trajectory that consistently outperforms the trajectory of people at identical skill levels who are still operating from financial fear.
Here is the through line connecting all 5 thresholds. The financial system is not neutral. It is optimized around assessing the risk profile of the person in front of it, and it offers dramatically better terms, access, and treatment to people on the right side of specific asset thresholds than to people on the wrong side of those same thresholds. The gap is not gradual, it is discontinuous. $4,000 of net worth, the difference between $98,000 and $102,000, is the difference between a brochure and a private banking specialist. The implication of this is that crossing each threshold as early as possible produces a compounding dividend that has nothing to do with investment returns. It has to do with lower debt costs, better rental options, stronger negotiating positions, higher quality financial advice, and a psychological security that changes how you show up in every professional context. The next threshold above where you currently sit is not just a number, it is a door. And on the other side of every one of these doors, the financial system treats you like a fundamentally different person. The math of getting there matters, but understanding why each threshold matters once you arrive is what turns a milestone into a platform.